Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with the Forex strategy video in which I want to concentrate on a particular currency pair, one that has drawn a lot of attention amongst our traders and has exceptional opportunity with the right push, and that pair is going to be the dollar-yen. Now, from the larger picture, we have a situation where a very prominent congestion pattern has developed and is now putting this in jeopardy of a potential breakout or breakdown. In general, a break from range. Right? Now, a big run-up like this and a topping pattern typically encourages people to project a decline. However, I do urge caution because you have to appreciate this for the bigger picture too. And when we do look at the longer term chart, we have a much different sense of condition. All right? We are still well off of peaks from previous years and decades. All right? So there is still a lot of room that we can see ongoing correction to the upside. All right? Because we're correcting a much bigger decline. Right. So sticking with the prevailing wind or the prevailing trend is typically good, a good approach to trading. Yet we have to be very open to the fact that this has been an exceptional rally to the upside, and we really have not seen strong progress since the Bank of Japan introduced its massive stimulus program. That was back in April. In fact, I have a nice comparison chart of how the yen crosses have performed since that particular event. You can see it here. And we really have not garnered much in the way of progress, or serious progress at the very least. All right? It's a concern. It's a concern because now we have taken what has been a key and ongoing catalyst, one of the biggest catalysts that has pulled us up to this point, that being the Bank of Japan stimulus program, and rendered it lacking for influence. All right, so now we have to transition onto what will really engage this into a meaningful breakdown or a meaningful break up, because we are right now at the very bottom of this congestion pattern, and I can wait for a break to the downside, and I would wait for a break to the downside because I like to see confirmation of bias before I actually take a trade. But if the view is that there is possibly a range trade here because this congestion holds, then I would want to get in relatively soon if that floor holds. And we have actually just about held that floor with the daily candle. So we're kind of in a limbo, in a gray area about what can actually occur. So what I did is I took a lot of the technical and fundamental implications and I try to lay them all out for myself visually. First and foremost, I think that this pair is quite interesting because of the technical pattern that we have on this daily chart. I have been looking at an 8-hour chart recently because I was watching the development of this diamond formation, and it did offer a break to the downside. Surprisingly, last night we had a sharp drop in risk trends, which was very prominent in the Nikkei 225. Translated nicely into the yen crosses and subsequently went into the high yield currencies as well. Didn't really help out the US dollar all that much initially, but you definitely saw it translate into the yen crosses and carry trade. Now, I also wanted to look beyond this. One of the things that I think is very useful in assessing the dollar-yen, which fundamentally is a difficult currency pair, because you're talking about two safe haven currencies, two well-known, renowned reserve currencies. They kind of compete on that balance. And it doesn't really give us a lot of straightforward view for how they can move, whether a appreciation on risk appetite trends or a drop in risk aversion, because it's not as clear as that. We also have two tremendous stimulus programs on both sides, and we also have uncertain growth conditions going forward. So it is a mixed bag. There isn't a clear winner. So what I like to do first from a technical basis is look at the dollar crosses and look at the yen crosses. Now if I look at the yen crosses, which we have been doing pretty regularly in the daily videos, we've had some pretty substantial developments. The Aussie yen was one that we were talking about a little while ago, and that had a tremendous, that was a fantastic break. That could not have been any more beautifully played from a technical basis. But you can see that we have pulled back substantially here. Nowhere near a congestion format that we have for the dollar yen, so it's not really that good of guidance. The same situation for a Kiwi yen. All right. And CAD yen is still within its own congestion pattern, but it is very close to rendering a break on its own if it does continue this move to the downside. A little bit more relatable to the dollar yen is going to be the European yen crosses. The euro yen pulled back from a multi-year high, now confirming a nice range or wedge top. Same situation with the pound yen, although that's a descending wedge top, and the Swiss yen. But they have not formatted into serious breaks to the downside, so no initial guidance, clear guidance from these yen crosses. And it becomes kind of difficult to actually interpret how this is translating into the dollar yen. So what I did was I actually just compared the US dollar, the Dow Jones FXCM dollar index, which is in the blue, and the Dow Jones yen index, which is in the purple, which is flipped upside down, kind of giving you a relationship to how these will perform. Now, interestingly enough, these two have been typically moving in opposite directions, particularly with that really aggressive move up that we had since September or thereabouts of last year, and that was the really big drop-off that we had in the yen at that same time. All right, but we typically would expect the two safe havens to be playing in the same, playing towards the same goal. That hasn't necessarily been the case, however, as we've seen a greater focus on stimulus rather than risk trends. Interesting. So I looked at the correlation between those two, and I set it against the dollar yen. Not much I can garner from that in terms of there is an imminent break potential to the upside or downside because the correlation has a historical bearing of XYZ. Now, negative correlations do suggest that we've, in the past, overrun run-ups, but as you can see, it's diminished its influence with this really incredible consistent push here. So we might have a scenario as we've turned to congestion of this talking about a downside move, but I wouldn't move on. I wouldn't take that as an individual standalone signal. Now, risk trends. We've talked about the dollar yen and the other yen crosses. On Aussie yen, I can see risk trends. If I want higher return and I'm not as concerned as volatility, I'll go long the Australian dollar. I will short the Japanese yen. Vice versa, if there's a fear in the market, I get away from the high yield currencies. I'm not interested in the high yield. I'm more interested in security. That means unwinding carry trade, and that means going back long yen. All right. You don't have as necessarily a straightforward measure when we're talking about the dollar yen, but you do see a sense of carry still. Because there's a broad element of carry trade appetite using the yen the yen currency as the funding. All right, and it translates, it spills over to the US dollar. Not necessarily people putting on a lot of new carry-focused trade through that currency pair, but it does occur. The S&P 500 is my baseline for risk trends, but perhaps the better one here is the measures the intricacies of the Japanese capital markets. We have the Nikkei 225. We know this correlation is very good, so we'll be watching the Nikkei 225 as general guidance to the dollar yen as well. And it has developed, lo and behold, its own very notable wedge formation too, though we are still some ways from that 14,000 level. In terms of the break potential, all right, there's certainly good readings for that. We have implied volatility. For those that aren't familiar, this is expected volatility backed out of options. This is short-term or 1 week expectations of volatility. This is an annualized expectation of activity. And it has dropped off aggressively to lows that essentially began the big run-up that really jump-started a lot of these yen crosses to trading celebrity as of late. All right, extreme low in the short term. This is the 3 months, so this is a medium term extreme low as well. This shows that the market is growing exceptionally complacent. You are certainly at a very high risk of breakout, and this complacency means that there's a lot of exposure here, meaning there's more likely to be stronger follow-through and greater volatility because of these conditions. All right. I talked about carry trade. Here's actually the yield differential on the dollar-yen. You can see the yield advantage for the US dollar is backing off. This gets a little bit further away from risk trends, which I like to do because, as I said, the dollar-yen risk considerations aren't as strong. And even though there isn't a really strong carry here, you can see that the yield that it does provide is starting to pull back as treasuries are being bid up once again and pushing those yields down. The JGB yields, the Japanese government bond yields, are falling as well, but at a more restrained pace, right? And they're not as heavily bid as treasuries. And then, of course, we can talk about stimulus. Stimulus was always a big conversation. As I said, we transitioned away from the traditional risk trends and really started paying attention to stimulus, whether it be a catalyst for taking risky trades or whether it be a ability to measure a better value on one currency versus another. Now, we've talked a lot about the depreciation of the Japanese yen based on the Bank of Japan's balance sheet, and while they don't do necessarily the numerical value that the Federal Reserve does, this is actually based in dollars, the difference between the Fed and Bank of Japan balance sheet, you can still see it has that strong continuation. Even when I do on a normalized basis, all right, so I'm comparing just the change over time without that shift to giving the percentage value to the particular Fed or Bank of Japan balance sheet, you can still see there is progress here to the downside. All right, so this can act as a snapback as well. So in general, the bias would be for something of a volatile break to the downside, founded on risk trends or founded on a carry unwind, which generally would occur through a risk trend move. But it has yet to be verified. All right. I would like to see a much sounder measure of risk aversion. A great catalyst would be the S&P 500 pulling back. As I said, this is a good measure of not just risk trends, but also stimulus confidence. So if this pulls back, that undermines two aspects of what really makes the dollar-yen fly. If we do get a break on the Nikkei 225 and the S&P 500, then I do expect to see a break here in the dollar-yen. I will look for a close below this trend line here. You can call it 97 flat if you want to be a little bit more conservative. Look for the previous swing low down here at 96.50 to break. They're pretty close together. It really doesn't matter that much. But as long as the fundamentals back a breakdown, that is the preferred view I have for the short to medium term. All right. Of course, the scenario of a range hold is possible, especially if risk trends are stable or positive, but I would not expect to have a lot of opportunity for making long-sided trades. All right. So keep an eye on this. This has great potential, and don't just look at it on an hourly chart. Keep that daily chart loaded. Good luck trading out there, guys. We'll do another Forex strategy video tomorrow.